Today, the crypto winter deepens. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and prop news with a distinctively Australian flavour. Well, wherever you look, the news from crypto land is getting worse and worse. For example, Bloomberg is reporting that long before Sam Bankman-Fried's FTX cryptocurrency empire collapsed this last month, there was already a lot of investigation going on in Manhattan. Sam Bankman-Fried's businesses owe more than $3 billion to their largest creditors, according to court filings, as the cryptocurrency group's huge bankruptcy process gets underway. But the US Attorney's Office for the Southern District of New York, led by Damian Williams, spent several months working on a sweeping examination of cryptocurrency platforms with US and offshore arms, and had started poking into FTX's massive exchange operations. The focus was on compliance with the Bank Secrecy Act. Authorities have used the law requiring financial institutions to take steps to prevent money laundering and terrorism financing to go after crypto platforms that allegedly falsely claimed that they didn't serve US customers. Bahamas-based FTX operated one of the world's largest international crypto exchanges, as well as a separate and much more limited venue called FTX US that said it complied with the act. Now, it's unclear whether prosecutors in Manhattan reached any conclusion in their probe before FTX, valued at nearly $32 billion in a January financing, collapsed, sending the crypto market into a dive and raising questions about the accuracy of its pledges to safeguard customer assets. The month-long sweep showed FTX's sprawling operations were raising questions even before billions of dollars in financial ties between the exchange operator and Bankman-Fried's Alameda Research Limited investment arm alarmed investors and led the empire to unravel. Prosecutors and regulators, including the Securities and Exchange Commission and Commodity Futures Trading Commission, are now seeking help from the new FTX Chief Executive Officer, John J. Ray III, who took over as part of its bankruptcy proceedings and is navigating what he described as a complete absence of trustworthy financial information. The crypto exchange FTX and linked companies founded by Bankman-Fried filed a list of their 50 largest creditors last Sunday, all of which are customers and owed more than $20 million, with two of them due more than $200 million. The company's total liabilities are estimated at more than $10 billion, according to earlier filings, and it may actually be more than 1 million creditors being owed money. In fact, the publication of the list as part of the Chapter 11 bankruptcy proceedings in Delaware had been delayed as bankruptcy practitioners struggled to locate reliable records at FTX Group, which collapsed earlier this month after a liquidity crisis and accusations it mishandled client funds. John Ray III, the bankruptcy expert who has taken control of the business and who oversaw the liquidation of Enron, said in earlier filings he had never seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information. FTX said it may need to update the creditors list as investigations continue regarding amounts listed, including payments that may have been made but are not yet reflected in the company's books and records. The filings show that 10 clients are owed more than $100 million by FTX. The top 50 creditors whose names are redacted in the filing are all owed more than $20 million. FTX said in earlier court filings that disclosing the names of its large account holders would be competitively damaging. FTX's clients included large financial groups that traded cryptocurrencies such as hedge funds, and unlike traditional exchanges, cryptocurrency trading venues also typically take custody of clients' funds. Customers who were unable to withdraw their funds before the firm halted payouts now face a long wait to recover their assets, if at all. In other recent cryptocurrency bankruptcy cases, including Voyager Digital and Celsius Networks, a key legal question has been determining whether account holders are unsecured creditors or have a higher priority status in determining who gets recovery payments first. Another question likely to arise is whether account holders who withdrew their money just before the bankruptcy filing are subject to clawbacks. The collapse of the exchange, which until this month was widely viewed as among the most reliable digital asset venues, has stoked fears that other firms could be at risk from their exposure to FTX and a crisis of confidence in the market. Shares in Silvergate, a US bank known for its involvement in crypto, fell around 30% last week. The bank has said that it has liquidity and capital ratios to support the volatility. And hedge fund Gallius Capital earlier this month told customers it had roughly half of our capital stuck on FTX. Based on Gallius' assets under management as at June, that could amount to around $100 million. In another filing on Saturday, FTX said the company had 330 workers around the world but was experiencing extraordinary attrition, and asked the court's permission to continue paying remaining employees it said were critical to the bankruptcy case. And as Cointelegraph reported, Bitcoin starts a new week still replaying November 2020 after its lowest weekly close in 2 years. The largest cryptocurrency, just like the rest of the crypto industry, remains highly susceptible to downside risks as it continues to deal with the fallout from the implosion of the FTX exchange. Contagion is the word on everyone's lips as November grinds on, just like the terror collapse earlier this year. Fears are that new victims of FTX giant liquidity vortex will continue to surface. The stakes are decidedly higher. The initial shock may be over, but the consequences are only just beginning to surface. These include issues beyond just financial losses as lawmakers attempt to grapple with FTX and place renewed emphasis on urgent Bitcoin and crypto regulation. With that, it is no wonder that price action across crypto assets is weak at best, and there are plenty of voices arguing that the worst is still to come. As clouds swirl over the fate of the FTX executives and ex-CEO Sam Bankman-Fried, commentators and crypto investors alike are wondering where contagion will strike next. Sentiment suggests that everyone is expecting the worst. A case in point comes in the forms of Genesis Trading, part of the digital currency group TCG conglomerate, which last week halted payouts at its crypto lending arm. This has not only set off a string of rumours over Genesis' solvency, but also over DCG's future. Reassurances from executives have failed to stem the narrative, which has also focused on the largest institutional Bitcoin investment vehicle, the Grayscale Bitcoin Trust, the GBTC. Over the weekend, a growing debate over GBTC mushroomed into a full-blown panic over financial buoyancy. As Cointelegraph reported, this was made worse by Grayscale refusing to provide address details to its BTC reserves, allegedly for reasons relating to security. Suspicions over $1 billion or so owed by DCG to Genesis added to the melting pot of misgivings. At the same time, some well-known investors had recently added to their GBTC positions. Is the next black swan GBTC already around the corner? Trading resource Stock Money Lizards thus queried on Twitter. Well, it may or may not be, but we are seeing precisely the same issues played out as played out in the global financial crisis, where once the first domino falls, more will follow. Now, I think there are two observations worth making. Firstly, the price of Bitcoin will continue, I think, to go south. Whether it ultimately finds a floor or not will depend on the breaking news. And of course, it cannot be completely disconnected from the broader crypto environment, as some are claiming. But secondly, nobody knows all of the interconnections and all of the pressures that are now flowing out from crypto land into the more traditional financial sector, particularly into hedge funds and others that took on very big positions and, of course, were trying to make money in the process. This is precisely a replay of the global financial crisis, except that this time the amount of regulation is much lower, the potential risks of loss are actually pretty high, and the contagion is probably even more profound because of its global nature, its digital nature, and the fact that there are very few controls. Watch this space. The crypto winter is going to get a lot colder yet. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.